You spend hours analyzing the chart. The technicals line up perfectly. Resistance is under heavy pressure, the momentum is strong, and a major move looks inevitable. You finally pull the trigger and buy the breakout. But the very next second, the market reverses. The profit you saw on the screen vanishes. Your stop loss is hit, and you are left staring at the monitor, wondering what happened. This experience is known as the fake breakout. Statistics show that over 50% of all breakouts in modern markets ultimately fail. That perfect technical setup was actually an intentionally engineered market mechanism called inducement, a trap designed to look like an opportunity. To understand the trap, you have to look at the apex predators of the market. We call them smart money, massive hedge funds and institutional banks deploying billions of dollars in capital. These institutions face a strict mathematical problem. Look at this scale. If a bank needs to sell $1 billion worth of stock, they absolutely must find $1 billion worth of buyers on the exact opposite side of the trade. Natural organic market liquidity rarely exists at that massive scale at any single specific price point. Smart money cannot simply wait for enough buyers to show up on their own. They must take active, forceful measures to manufacture that demand. Because they are too large to move quietly, they manipulate price action directly, engineering fake scenarios on the chart to generate the liquidity they desperately need to fill their orders. This chart shows a stock hitting a strong resistance ceiling. Smart money pushes the price over the line, simulating a breakout. This triggers short sellers' stop losses and retail FOMO, flooding the market with buy orders. Smart money then dumps massive sell orders, violently crashing the price. The textbook breakout was an illusion, a giant nut cast by institutions to harvest retail stop losses and FOMO to fuel their own exits. Because smart money requires massive capital to move the market, their sheer weight leaves undeniable tracks. You can spot the trap before it springs. Forensics begin with the candle wick. Jumping into a live, moving candle is an error driven by emotion. You have to wait for it to close. Watch how this candle forms. A candle with a tiny body and a massive upper wick, often called a pin bar or a shooting star, proves that buyers were violently rejected before the close. Institutional footprints also appear in the volume. A legitimate institution-backed breakout requires an immense injection of capital, which always results in tall volume bars. Look at the bottom axis of this chart. If the price breaks out but the volume bars remain flat and dry, the move lacks real institutional muscle. RSI divergence provides a final layer of evidence. Think of this like a car speeding up a steep hill, while the engine simultaneously loses power. This split chart shows the technical warning. The price at the top creates a higher high, but the momentum indicator at the bottom simultaneously forms a lower high. It signals hidden weakness. By cross-referencing these footprints, wick rejection, low volume, and momentum divergence, you can identify an institutional illusion before you commit your money. To override emotional trading and neutralize FOMO, you need a strict mechanical checklist. Steps 1 and 2 require analyzing the broad market context and identifying the obvious trap zones. This means finding where retail stop losses are clustered, typically right above equal highs. Step 3 involves a microanalysis at the exact moment of the breakout, scanning specifically for wicks, dry volume, and RSI divergence. Step 4 focuses on execution. You must wait for a safe retest of the line, or trade in the opposite direction to profit off the trapped crowd. Consistent profitability comes from mastering internal emotional control and decoding the predatory psychology hidden behind